Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Oil steadies after its biggest one-day jump in almost a year. Markets rattled after President Joe Biden says the U.S. is discussing whether to support potential Israeli strikes on Iran's crude facilities. Will there be a September surprise? As the Fed watches, we're going to have your guide to today's crucial monthly jobs data from the US. And split on tariffs. Germany calls for the EU to drop its plans for 45% levies on Chinese electric vehicles. We're going to preview today's decision. Well, happy Friday, everyone. Markets are currently in something of a holding pattern ahead of the non-farm payrolls print that drops at 1:30 p.m. UK time with a survey forecast of 150,000 for the month of September. But importantly as well, the unemployment rate expected to stay stable at 4.2%. But if that moves higher or lower, of course, that could feed in to the bets around where the Fed goes next with 25 or 50 still being debated. Markets pricing in right now around 60 to 63 basis points of cuts by the end of the year. The geopolitics, of course, remains central, the tensions in the Middle East, and that is also feeding into this sideline view, at least for some in the markets, until there's more clarity on the response from Israel to Iran. European futures currently then edging higher by 0.1% after losses of around 0.9 yesterday. FTSE 100 is currently flat here in the UK. S&P futures in similar territory. Nasdaq futures pointing up by just 15 points. Let's flip the board and check in cross asset then before we get to the Asian market deep dive. And currently on the US 10-year, 384, there's going to be sensitivity, particularly around the front end of the US Treasury curve, potentially on the non-farm payrolls data. We had jobless claims out yesterday, relatively benign picture there, and services coming in strong, better than the estimates, suggesting that there is still resilience in that US economy. In terms of the Bloomberg Dollar Index, you have, of course, seen significant moves into the dollar, currently just down 0.1%. The geopolitics playing into that currency as well as a safe haven bid. Talking of the geopolitics, Brent at 77.54 after the spike in prices yesterday, currently down 0.1%. Mixed messages from the US President Joe Biden seemingly suggesting that an attack on the crude facilities of Iran is a potential option. Gold then on the safe haven play as well, getting a bid this morning, up 0.3%. Let's check in on the Asian market. You've seen further strength over in Hong Kong, particularly with those Chinese tech companies listed on the H-Tech index. The HSI is gaining so far in this session, up 2.2%. That is lifting the broader regional gain up 0.3%. Japanese yen weaker by 0.5. The Nikkei up 0.2%, a further lift there for Japanese stocks. As we listen in as well to the Japanese Prime Minister giving a speech expected to start, if it hasn't already started, and we'll be listening in to that as well. Any commentary on monetary policy will, of course, be interesting. Now, markets are, of course, on edge for what could be the biggest data print this month. The US unemployment report for September due later today. Joining us now is our markets reporter, Valerie Teitel. Valerie, what are we expecting?
Oh, it's a big day for the markets, Tom. The headline number is 150K, with the unemployment rate expected to stay the same as prior month at 4.2%. Average hourly earnings also expected to stay the same at 3.8% year on year. But what makes this report special, Tom, is that the range of predictions is very wide. September is historically a month that has a lot of complicated seasonal adjustments. And on this headline number, the predictions range from 70K all the way to 220. I also urge you, Tom, to keep an eye on the revisions. The revisions have been very weak to prior months. Some would argue that the market reaction to last month's print was all about the steep revisions to the month prior. So keep an eye on that. Heck, Tom, I even urge you, take a look at the second decimal on that unemployment rate. The market is really going to pick apart this report, and it's all because of the emphasis of Jerome Powell. I want to take you back to his speech in Jackson Hole just in August. this. Jerome Powell told us that we do not seek or welcome further cooling in the labor market conditions. The market really ran away with this, saying that the Fed is going to be there to protect the labor market, and that is their main focus. He went on to say in the Q&A just a few weeks ago that the unemployment rate is the single most important one, probably, when it comes to the direction of Fed policy. Let's take a look at the chart of the unemployment rate recently, and I want to talk about the calls from Citi. They are one of the most bearish out there today, calling for a 70K payroll, 70K headline payroll adjustment, and they actually think that the unemployment rate, there's risks that it could rise not just to 4.3%, but to 4.4. They specifically pull out the weakening labor market sentiment when it comes to the Conference Board's jobs too hard to get sentiment indicator. Tom, this is a big report for the market today, but remember, we do get one more payroll print before the Fed convenes again on November 7th.
Heck, Tom. Valerie Teitel is back, everyone. Valerie, thank you very much for the breakdown in terms of what to expect from the non-farm payroll. 4.4% unemployment. That would be a standout. That would put 50 basis points back on the table, wouldn't it, for this Federal Reserve? Let's get back to the geopolitics right now, particularly what has been playing out in these oil markets. Oil is steady in the session this Friday, but that follows its biggest one-day jump in almost a year yesterday. Brent trading currently just below $78 a barrel following comments from President Biden when asked about supporting potential Israeli attacks on Iranian crude facilities. The answer was confusing. Let's get some clarity right now and bringing Anthony DePaola, our Middle East energy markets reporter who joins us from Dubai. Anthony, walk us through the impact on the oil market and what exactly Joe Biden had to say.
Yeah, good morning, Tom. That's correct. Joe Biden did make a comment that was unclear when asked if the U.S. would support an attack on Iranian oil facilities by Israel. He gave a vague answer saying we're discussing that. So I think even though that was unclear whether he was discussing that with Israel, whether they're discussing that within the administration, an official later did clarify that there had been no decision yet. But just that initial idea that they were thinking about it was enough to spark another increase in oil. And that's, as you said, a 5% increase, the second one that we've seen this week. So already we've seen oil coming up quite strongly on that succession of Israeli attacks against Hezbollah in Lebanon and the increasing ground incursion there, as well as that Iranian attack and the concern over reprisals there. So we are seeing some notes coming in from some of the investment banks talking about what could happen if some of the major facilities were hit, and that would result in a loss of supply, a loss of some Iranian supply, potentially, if that does happen. So far, we haven't seen any real supply interrupted, and that's why the oil price has been so contained so far this year, despite all the geopolitical risk going on. Traders just haven't seen that supply interruption, and that hasn't caused a jump in the price up until now this week, where we're seeing those jumps, Tom.
Yeah, so 77.53 on Brent, 73.64 right now on WTI. Anthony, you talk about some of the expectations, the estimates coming through from some of these investment banks. What are the potential scenarios in terms of pricing around oil on whatever action Israel does take? And is there additional supply that can come onto the market? How do the Saudis react in that kind of environment?
I mean, so far we've seen roughly 5% jumps, kind of knee-jerk reaction so far this year. Anytime we see some geopolitical risk, we've already seen that basically happen twice this week. So we are in kind of a higher risk period. It really depends on what type of facilities would be impacted. If we saw crude production or export facilities targeted, that, of course, would have an impact directly on the market because that could potentially curtail supplies. Now, the easiest things to hit would be potentially storage tanks or export terminals. Iran does have a very large export terminal called Kharg Island, which is the main export terminal for all their oil flows, all of which go through out of the Persian Gulf and through the Strait of Hormuz. Oil fields is something that's harder to hit, obviously, because they're underground. There are above ground installations, but those are a little bit harder to target and take out. Refineries would be more of an issue domestically. We've seen Ukraine, for example, in the Russia war, hitting Russian refineries that supply that domestic market while avoiding some of those more export-oriented Russian refineries. Well, in Iran, since they're under sanctions, they're not really allowed to export any refined products, or rather, other countries are not allowed to buy those products. So hitting some of those domestic refineries could potentially damage fuel supply to the domestic economy in Iran. And Iran is largely self-sufficient now on things like gasoline, because they have been so cut off and so unable to import. So it really depends on what kind of facilities they would attack. Iran's producing close to over 3 million barrels, so close to what they were able to do without sanctions, because the regime has been so permissive of late. They are exporting 1.5 million barrels a day, give or take. OPEC Plus is curtailing production, so they've got a lot of supply that could come back on. So in an emergency, OPEC Plus could rush some supplies back to market to replace that Iranian crude. But from what we're hearing, everyone is trying to avoid that kind of situation, Tom.
Okay, Anthony Di Paola, our Middle East energy markets reporter. Thank you for the analysis. Oil up about 8% so far this week. Potentially a high-stakes weekend then, of course, for the region and the oil markets. Now, Germany is reportedly planning to vote against EU tariffs on Chinese electric vehicles later today. Reuters quotes VW as saying they are the wrong approach. Linda Liu, our Asia transport reporter, joins us from Hong Kong. It's pretty fascinating, the splits that this whole debate is having and causing within the EU. How do we expect other EU members to vote? Where does France line up if Germany is opposed?
From the reports that we're seeing, France is expected to vote in favor of this proposal, as are Greece, Italy, and Poland. Now, together, these four countries represent about 39% of the population of the EU. Now, this means that if these four member states vote in favor of the tariffs, it means that a majority bloc, which would have required 50 member states, representing at least 65% of the bloc's population, to oppose these tariffs. So if these four member states go ahead with their decisions, it means that we're likely to see the tariffs come into effect.
What are the potential implications then if the tariffs do come into effect? You're sitting there in Hong Kong. Has Beijing made it clear what their response would be?
Yes, we've seen a lot of overtures from Beijing in the past year since this proposal has been announced. Now, there's a big threat of a trade war escalating between China and the EU. Beijing has launched anti-dumping investigations into brandy as well as pork. Now, the decision with how these anti-dumping investigations will go is likely to depend on how EU decides to proceed with the tariffs. Other than the pork and brandy, there's also hints that Beijing would launch actions against large engine cars being imported into China, as well as dairy. So if a trade war escalates, it could really hurt the producers of these commodities, as well as companies that work in the auto industry.
OK, Linda Liu, Bloomberg's Asia transport reporter, on the details. So we count down to that decision then and that vote in the EU on the contentious subject of tariffs on Chinese EVs. Now, you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal. And we're going to be speaking exclusively to the Chicago Fed President Alston Goolsbee after the jobs report. That interview at 3 p.m. UK time after yesterday he signalled the need for rates to come down pretty significantly from here for the Federal Reserve. Coming up, the G7 warns of a dangerous cycle of attacks and retaliation that risks fueling uncontrollable escalation in the Middle East. We will have the latest from the region next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Israel says it bombed more than a dozen Hezbollah targets in Beirut yesterday. This as G7 nations warn against an uncontrolled cycle of escalation in the Middle East. The region is bracing for Israel's response to Iran's missile barrage earlier this week. For more, Ros Mattson, Bloomberg's EMEA News Director, joins me with the details. Ros, what do we know at this stage about Israel's potential response? How crucial is this weekend in terms of a potential step up again in terms of how Israel responds to what was another historic week for this region?
Well, it's obviously a very delicate calculation for Israel at this point. What do they do to respond to the ballistic missile strike that Iran did on them earlier this week? What's a calibrated response? It has to be more than what we saw in the tit-for-tat that happened back in April. So it's going to be a more intense response this time. But again, it needs to be that response that sends that message without tipping it even further into yet a higher level of escalation. And so what does that look like? Is it targeting military sites, potentially targeting oil installations inside Iran? And that's what you can see the oil market is now a bit worried about, because that would really start to tip us into the question about supply of oil. Or is it the nuclear sites? And that would really be the big one. We've seen the US express a high sense of unease about the possibility of that. And it's very difficult for Israel to hit those nuclear sites without the US assisting. So that's probably off the table at this point, but it certainly seems to be they're discussing with the US as well, like whether it's, going to be feasible to strike these oil targets. And again, that's going to be quite an escalation from what we saw previously.
Yeah, and you had those slightly confusing and slightly odd, surprising maybe comments from US President Joe Biden around that potential option on the oil infrastructure of Iran. Talking of Iran then, of course, central to this whole scenario, the Supreme Leader is going to be leading prayers and is leading prayers today. What do we know about the positioning of Iran in the build-up to what looks like an almost certain strike from Israel?
Well, it's quite delicate also for Iran. You can see the messaging that's coming from Ayatollah Khamenei, obviously directed very much at the people of Iran in recent days, sort of deifying the Hezbollah leaders who've been killed, talking about Iran's need to defend itself and warning very clearly again about don't come for our nuclear sites, because that's really going to take things to a whole new level. And so issuing those warnings, the right to defend itself and so on, but clearly knowing that something's coming and perhaps trying to manage the messaging with the US and Israel about what they might tolerate in terms of the kind of response that we might see. And so we know there are back channels going on still with the US. Iran and the US do have those channels. They seem to be open and working, and perhaps, Iran is using that to send messages to Israel, which is, again, these are the things that are going to really kind of escalate things in a way that neither of these countries seem to want at this point. And again, that's really about the nuclear facilities.
I just wonder to what extent inside Israeli thinking and in terms of the government, they feel like they've exposed Iran as something of a paper tiger. Some of those ballistic missiles got through, but some of them were misdirected, some of them misfired, it seems. When it comes to the operations on the ground, of course, Israel would clarify, or at least they would frame this as success that they're having against Hezbollah. What do we know about what's happening on the ground in Lebanon?
Well, obviously, as we're seeing, there were strikes again on Beirut overnight. So we're seeing heavy strikes on Beirut at this point, multiple sites being hit, obviously targeting further elements of the Hezbollah leadership. There are still some of them there, obviously, and the question is who's going to succeed, the Hezbollah leader who was killed, Nasrallah. Are they going for the next in line? And so we're seeing lots of airstrikes on Beirut itself. We're seeing, of course, Israeli troops operating over the border still in Lebanon, and those sort of forays seem to be extending. Israel talked about a limited and targeted ground operation. Days later, it's still going on. And we know that there are exchanges that are happening between Hezbollah fighters and Israeli troops in those areas. The question is, does Israel get bogged down over the border? And we see this limited, action, becoming protracted. There's always the risk of that. And so what we're seeing, obviously, is multiple fronts now for Israel inside Lebanon, the aerial strikes that are going on. And, of course, we're seeing the death toll rise in Lebanon as a result. More than 1 million people we know already being displaced. And what we're seeing is potentially, this could escalate towards that kind of similar humanitarian crisis in a way if you see a large exodus of refugees coming from Lebanon. So it's having knock-on effects that we can see already.
More than 1 million people already made refugees, or at least fleeing some of those conflict areas. Ros Mattson, thank you very much indeed on what is the latest in terms of what is transpiring in the Middle East on what could be, again, another crucial weekend for that region. Ros Mattson, Bloomberg's EMEA News Director, thank you. Coming up, we're going to look at how the UK, we're going to switch focus and look at how the UK became the first G7 nation to phase out coal power. The details on that coming up. This is Bloomberg. Welcome back. Now, the UK reached a milestone earlier this week when it became the first G7 member to fully phase out coal from its electricity mix. Joining me now is Anu Tan, an associate in Bloomberg NEF's European power team, for the details on how the UK got to this point. What lessons can be learned, maybe from countries like Germany, for example? How did the UK then, thanks for joining us, Anu, how did the UK manage to bring its coal era to an end, finally, this week?
So the UK put into place a very firm phase-out target that was 2025 at the time. And at the same time, the UK also had a very old fleet of coal plants. So that really helped in its favor in terms of phasing out coal. So in the earlier years, what happened was they put into place a carbon emissions limit. This meant that coal plants didn't have a lot of hours to generate in a year. This led to a first tranche of phase-outs. And then after that, as carbon prices started to rise, it became very expensive to turn on a coal generation plant, and to the point that many plants were unprofitable. And this is what led to phase-outs right until Uniper's Ratcliffe-on-Soar plant on Monday.
So how do they manage to get the balance between phasing out the coal capacity but making sure that the UK could keep the lights on?
So it is a delicate balance indeed, and what UK had in its favor at the time was a sizable gas fleet. Now, gas, as we know, produces a lot less emissions than coal, so it was a very useful transition tool. The UK also took it one step further and put into place a capacity mechanism that paid gas plants to ensure that they stayed online and they were able to support the shutdowns of coal, ensuring a very smooth phase-out.
To what extent? So you talk about the role of gas there as that transition fuel. Do you apply the same playbook then to gas, using that to transfer away from gas to renewables? To what extent is the playbook around coal now being applied to gas?
So gas does indeed need to abate its emissions at some point, but it's not going to be as straightforward as coal. That's because gas for now doesn't really have an economically viable replacement just yet. It's not at commercial scale. Abatement technologies are also not quite up to speed yet. So the UK is going to employ various policies, firstly to get gas out of the picture, or at least to abate emissions from gas. And this could mean subsidies, or they could follow the lines of US markets, which have put into place tax incentives. So there are many options in order to work towards the gas phase out.
OK, Anu Tan, associate from Bloomberg NEF's European power team. Thank you very much indeed on how the UK managed to phase out coal completely. And it happened this week. Maybe some lessons as well for some of our European partners. If you'd like to hear more from BNEF's analysts, then download the Switched On podcast on Apple, Spotify or wherever you get your podcasts. And by the way, the BNEF Summit, where energy, finance and technology converge, kicks off in London next week with a stellar lineup of guests. You can join virtually using the QR code. There it is on your screen. Scan it. Join virtually or in person. It all starts on Tuesday. Well worth tuning in for. There's plenty more coming up. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Oil steadies after its biggest one-day jump in almost a year. Markets rattled after President Joe Biden says the US is discussing whether to support potential Israeli strikes on Iran's crude facilities. Will they be a September surprise as the Fed watches? We're going to have your guide to today's crucial monthly jobs data from the US. And the strike is over. Dockworkers agree to resume work as talks continue, ending a 3-day stoppage at ports across the United States. Let's check in on the markets. That will be a positive for the port story, the end of the strikes, in terms of supply chains and in terms of the broader economy. It could take a couple of weeks to work through that 3-day stoppage. European futures pointing to gains of 0.2%. The countdown is on to the non-farm payroll print, the jobs data, with estimates looking at around 150,000 and an unemployment rate of 4.2%. FTSE 100 futures currently flat. S&P futures just edging higher by 0.1%. Nasdaq futures looking to add 32 points so far as we build up to the open stateside. And of course, the jobs data could well inform how we think about whether they go 25 or 50 at the next meeting. Let's flip the board and look cross-asset with the US 10-year in focus. The Bloomberg Dollar Index has seen that strength come through as well. The Bloomberg Dollar Index is currently down 0.1%, but it is still on track for the biggest weekly gain in 6 months. Some of that down to the geopolitics, to the Middle East risk, and to the move to safe havens. Talking of safe havens, gold up 0.4% so far in the session at 2,667. And your 10-year yielding 384. That could be adjusted, of course, around the non-farm payroll print. That is the benchmark, 384 right now on the US 10-year. And Brent, $77 now, 51. After that surge yesterday, just off by 0.2% so far in the session. But we continue, of course, to keep an eye on the oil complex, given the risks in the Middle East. Let's get back to some of the macro data and do a deep dive on how to be thinking about the jobs picture in the US and the pricing around the Fed. Is 50 basis points an option for them if the labour market weakens substantially? Let's bring in Aneeka Gupta then, Director of Macroeconomic Research at WisdomTree this Friday morning. Aneeka, thanks for joining us. Is there a print? What level of unemployment? We're looking at 4.2%. If we get 4.3 or 4.4, does that put a jumbo cut back on the table for the Fed?
Morning, Tom. Yes, it does definitely put some risk back on the table and increases the likelihood of a 50 basis point rate cut. For now, the Fed is clearly pushing back against the market's very dovish expectations for rates going into year end. And I think just obviously this payroll report is going to be quite important, but also thinking a bit ahead, as you mentioned, with the port strikes that have been taking place so far. I know they have called it off, but that is also going to be adding quite an interesting mix to the next payroll report, where we could see some 45K workers actually being taken off, and we could see a much bigger and more deeper slowdown in the next payroll report. So if this one does come in, below expectations, we're stipulating it at around 140K. If it does come in a lot lower, alongside a higher unemployment rate, that would definitely increase the likelihood of the Fed easing at a much with a wider stance.
OK, so we have about 63 basis points priced in by the markets so far, leading up to the end of the year. And we'll see how that adjusts on the back of today's data. And then pushing out to July of next year, about 150 basis points of cuts priced in. Larry Fink telling Bloomberg earlier this week he thinks that is the market's getting over its skis in terms of how much is being priced in. Do you agree with that? Does 150 basis points by July of next year seem reasonable at this point?
Well, on the face of it, it really depends on the data. This week itself, we've had a slightly better print on ADP numbers. We've had a much stronger ISM services print. And that tells us the US economy so far, at least on the services side, continues to remain quite resilient. The real loophole where we're seeing across the global economy has been on the manufacturing side. And so if services, which account for a much larger share of US GDP, continue to hold up, that just builds the case for a lower likelihood of a very aggressive easing path. And so it all really boils down to the labor market. So far, we are seeing a slowing in hiring, but we're not seeing a very big shift towards layoffs. Now, if we do see any momentum picking up on the layoff side, yes, that would give way to a correct expectation of a much aggressive pace of rate cuts.
On the BOE, Aneeka, was the market kind of repricing? We saw the softness in the pound yesterday. We saw yields down across gilts, particularly in the 2-year. Was that a rational reaction to the interview that the governor gave, or is that a little bit overdone?
I don't think it's overdone. I think we're seeing a very sharp shift amongst central banks, communication over the past week. The BOE is clearly an example. The last Bank of England meeting, the communication was quite clear that the Bank of England is going to be treading quite cautiously. And in the statement given by Andrew Bailey just yesterday, it looked like a much faster pace of rate cuts. And hence, the market rightly adjusted its expectations, and you had quite a considerable decline in the pound. If you even take an example of for the Bank of Japan, we've had Prime Minister Ishida really clear his stance. He's always been viewed as a much more holding a much more hawkish stance, but he even cleared the ground by saying that he believes that the Bank of Japan is not really in a position to go ahead with policy normalization, and hence you saw the yen react quite strongly versus the dollar and actually decline at one of the highest levels that we've seen since August. So I think we have seen a swift, sharp turn in a number of central banks, and it's also in reaction to what the Fed's first move has been when it's embarked on this rate cutting cycle.
Aneeka, do these trajectories, the inflation trajectories now from these central banks and the forecast, do they risk being blown off course by higher oil and the events in the Middle East?
Absolutely. That's why markets remain on tender hooks. We're essentially looking via one key lens, and there is always this external unknown risk. This is what the market is really waiting for. What are going to be the retaliatory impacts that Israel is going to take forward? And any statement by any political leader has quite an important reaction, because the markets is waiting to get some kind of guidance on what is likely to take place in the Middle East. And we have already seen a considerable appreciation in oil prices on the back of this conflict that is continuing to escalate in the Middle East. And so there's always that risk if we do have higher energy prices staying elevated for a longer period of time, that will be readjusted in those inflation expectations.
OK, Aneeka Gupta, Director of Macroeconomic Research at WisdomTree, on the factors playing into the thinking of these central banks. And with a forecast of around 140,000 from the non-farm payrolls, the jobs data out 1:30 p.m. later today. Aneeka, thank you as ever. And Aneeka talked about the US Dockworkers agreeing to suspend their strike. We've got more details on that now while they continue. So they're suspending the strike while they continue negotiations on a new contract until, I believe, January. Container ports from Houston to Miami have been closed since Tuesday. It's been absolutely massive, this strike, creating a backlog of cargo that could take 12 days to clear. Let's bring in Bloomberg's Bill Ferries for the details then. Bill, the consequences of this strike, the ramifications were being assessed with some expectations of a potentially $5 billion hit per day to the US economy. But it's been resolved after 3 days. How do they get this resolution so quickly? What's left to be negotiated?
You're right. The costs were going to be building up from a few $100 million a day up to potentially $5 billion or more per day. So that put a lot of pressure on all sides to try to get something done quickly. Listen, at its core, there were a couple key issues the unions and the ports were haggling over. The big one for the union, perhaps the biggest one, was wage increases. They don't feel like they've been getting them. They feel like the ports have been benefiting. This deal, the tentative deal, or I guess partial deal we have, will give those workers a more than 61% pay raise over the next 6-year contract. So that has largely been resolved. They're going to keep discussing issues on automation, port automation, that could put people out of work through at least mid-January at this point. The big issue, of course, is this kicks it well past the presidential election, and that's something that at least some sides of this debate wanted to get past.
Well, Bill, there you go. You touched on the politics, and we know Biden had some kind of leverage on this. What are the potential political impacts then? Does the Biden administration, does Kamala Harris then, as a result, gain on the back of the fact that this strike has been resolved?
Well, I don't know if she'll gain, but she doesn't lose from the strike being continued. And I think that was a major concern within the administration. Listen, this administration is dealing with the Middle East conflict expanding. It's dealing with the damage from this Hurricane Helene, where people are still, search and rescue teams are still out there. Having a port strike on top of that, with you possibly having shortages of some goods and We already see it's going to take 12 days or so to work through the backlog of ships that have built up. If this had gone on for weeks, it was going to become a big problem for the administration and something certainly that Donald Trump and Republicans would try to capitalize on. So I think they very much saw it in their interest to try to get this taken care of as soon as possible. It's not totally resolved, but as we said, one issue, the salaries, is taken care of, and they'll focus on automation and technology issues over the next 3 or 4 months. We'll know who the next president is at that point, and it will fall most likely into the next president's lap.
Yeah, 60% or so increase in salaries for dock workers over a period of years, of course. Bill Ferries with an excellent update on the situation there, the resolution, at least for now, of that strike across US ports, joining us out of Singapore. Bill, thank you. Coming up, I'm going to be joined by the CEO of the digital healthcare platform Huma. We're going to discuss the company's latest acquisition. Stay with us for that conversation. This is Bloomberg. Welcome back. Now, healthcare technology company Huma has announced the acquisition of the consultation platform eConsult. Huma's technology is already used by more than 2/3 of all primary and secondary care providers in the UK. The eConsult platform is used by the majority of GP practices, for example, for remote consultations. Very pleased to say right now, being joined by Huma's CEO, Dan Vahdat. Dan, thanks for joining us in the studio. You are back. Your company's backed by the likes of AstraZeneca, by Bayer. You've raised about $300 million so far, so you're firmly in unicorn territory in terms of valuations. And you're being acquisitive. What does this acquisition tell us about your ambitions, the company's ambitions going forward?
Huma's mission is accelerating adoption of technology and digital across care and research. And we think that is really important because with technology, you can make care accessible, consistent, and proactive. Now, as a company, you can build certain things yourself. But if you want to really be the true end-to-end platform to go through the journey of the patients from the screening to triage, automated consultations, and monitoring, is something that you may need to partner with others. And that is why we are a very big believer of better together stories. And this is why sometimes we partner with companies and acquire them.
OK, it sounds like, given that ambition then for that broad platform, that you are going to continue to be acquisitive. You're looking at other targets. Do you have the cash, the balance sheet to be able to pull the trigger on more acquisitions? Because it's a very competitive space, the digital and the AI healthcare sector.
That is correct. So as a company, we have, as you know, we launched the Huma Cloud platform that enables us to launch applications really easily and scale them globally and grow horizontally through our own organic play. And we have massive ambitions on that part. But also in parallel, if I can, and if we find targets, we would buy like tens of companies and partner with them to bring that kind of Apple-like experience to the patients, to the providers, and health systems. OK, tens of companies you'd be willing to buy if they were there for an Apple-like experience. Are we seeing the impact, yes, of the adoption of this technology? I still have to wait 2 weeks to get a GP appointment. I have to log on at 6 a.m. I tend to be on air at that point to try and get an appointment. Where are the benefits of this coming through? This is exactly the same problem we are trying to solve for the patients. But also when you look at from the GPs and doctors' perspective, they have a really bad experience with the technology and software. And the same way that we all deserve to have a technology like mobile and iPhones to be able to do communications, taking pictures, having our files, and everything we need to do in our life, we're really trying to bring those kind of suite of applications to the patients. So you don't need to wait a long time. You can do your triage and put your kind of conditions. And maybe for most of your conditions, things can get sorted automatically with the supervision of a doctor rather than needing to go to the clinic, because for most cases, you don't have to. As well as from the clinical side, you really want to ensure that doctors, they spend their time on the cases that they really need to spend their time instead of like 10 minutes rushing or 5 minutes rushing from one patient to another patient. And that is really frustrating for doctors.
I was about to say, we'd be lucky you get 10 minutes with a GP in the UK on the NHS. The NHS, it doesn't have a happy history in terms of IT adoption. How do you keep our data safe?
So one of the most important things for us as a company, we have built this platform that is software as a medical device, regulated platform. As you know, we got our FDA Class 2, EU MDR Class 2B. And since the very beginning, we've been very committed to ensure that we follow all the regulations and processes for security, for safety, for effectiveness of our technology. And it's something that is embedded into the DNA of the company.
Okay. US ambitions, you're approved by the FDA for some of your platforms. What are your US ambitions, the growth ambitions in that market? And what are revenues looking like at this point?
So United States is a $4 trillion healthcare industry. And as you know, the cost of care is really, really expensive there. And we think there is a lot of opportunity for us to be able to deploy our technology and provide this proactive, predictive care and enable a lot of patients that at the moment they're not getting the right care, the right treatments, even in the advanced system like the US, to benefit from our technology. To give you one example, we have 100 million hypertension patients in the US. So basically 1 out of the 3. And these patients are the patients that you can totally manage them and stop the deteriorations a lot earlier and avoid heart attack and all the other consequences that can happen. With our technology, we can help them. And then obviously there are lots of other conditions and diseases from cancer, COPD we can do.
What are revenues looking like? Are you still on track to be profitable by the end of this year?
We are really working hard toward it. We set this ambitious goal for ourselves, and we have performed really well toward our goal.
Okay, so you've raised $300 million US. That gives you some runway, presumably. That was Series D, so late stage. What are your IPO plans? Is that a prospect for next year?
I don't think we will focus on IPOing next year because for us, we are really keen to do an IPO when we can do a very big IPO. We don't want to do like few $1 billion IPOs. So my target is to get to 10 billion plus and then think about the IPO. But again, we look at the market, the dynamic, what we need to do at that point in time, and we make the decision.
Okay, you want to go for a mega IPO. I get that. That makes sense. Would that take you to the US versus the UK then?
It's a good question. We are looking at options and all the time and talking to different stakeholders. US obviously is very appealing for technology companies given the liquidity, access, and so on, and given that US are the largest market from a business perspective. But we will see.
Okay, that sounds like you're leaning towards the US when that IPO plan comes forward. Dan, thank you very much indeed on the acquisition story for Huma, the growth plans as well around the US market. Dan Vahdat, CEO of Huma. Okay, next week on Daybreak Europe, we will be featuring a slew of startups from Unseen Labs to DeepKey and Luminance. Those conversations will be starting on Monday, 6:40 a.m. We're going to bring you insights from some of the key players across the European space, some really fascinating founders and startups, and as well individuals involved in funding some of those efforts. So do stay tuned for those, 6:40 a.m. all of next week. Now, some other stories making news this Friday. French Prime Minister Michel Barnier has announced targeted tax hikes to cut France's budget deficit. The temporary tax will be limited to companies with 1 billion euros of annual revenue or more, hitting about 300 of the country's biggest companies. Individuals on high incomes will also be asked to pay more under the plans. And Bloomberg's been told that online fashion retailer Shein is preparing to start informal investor meetings to gauge interest ahead of a potential London IPO. The source says the Singapore-headquartered company is awaiting regulatory approvals in both China and here in the UK. And now look at our global rich rankings with a change near the top. Mark Zuckerberg is now the world's second wealthiest person, jumping ahead of Amazon's Jeff Bezos and trailing only Elon Musk. The Meta CEO's net worth hit a high of just a mere $206 billion, more than $1 billion ahead of Bezos. There we go. A happy moment for Mark Zuckerberg. There's plenty more coming up. Stay with us. This is Bloomberg.
The Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. but keeping on that very, that nice edge. Growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
OK, former New York Fed President and Bloomberg opinion columnist Bill Dudley, who's also been writing about why he's walked back his hard landing views on the US economy. He no longer sees a hard landing there. Here's where the focus is now. Laser focused, the Federal Reserve, on this jobs market. And here's what's been happening then. From the start of this year, the blue line is indicating that how hard jobs are becoming to find in the US. The white line is the unemployment rate. You've seen a recent modest tick down in terms of unemployment, currently at 4.2%. The expectation is that the numbers today will show 4.2% holding. It is becoming harder to find jobs now in the US. And Jay Powell has been clear. He does not want to see a further deterioration of the labour market. So 150,000 is the estimate for non-farm payrolls today, 1:30 p.m. UK time. The unemployment estimate is 4.2%. If, though, you get 4.3 or 4.4, does that put 50 basis points back on the table for this Federal Reserve, given what we know about Jay Powell and his intention to firm up the labour market, at least not see any further weakening? And that is the softness that has come through. Relative, of course, but you have seen that slight cooling of that labour market stateside. Let's flip the board and have a look at what's happening in terms of the potential impact on the small caps of the US as well on the rate trajectory. And this is the number of Russell 3000 companies that cannot afford their debt pile. Over the last 12 months, you've had about a third of the Russell 2000 not making enough in terms of revenues to pay down their interest payments. They're sitting on about $1.3 trillion of debt. And now, when you had that 50 basis point cut from the Fed, you saw yield spreads being crushed and markets, investors moving into the riskiest, junkiest parts of that market. But of course, if you don't get that soft landing, then those small cap companies are, of course, at risk. Here's the picture in terms of non-farm payrolls. We talked about that. 150 is the estimate, 4.2 in terms of unemployment. Now, Bloomberg Terminal users can get access to these charts and others, of course, through GTV on the terminal. Opening trade is coming up next. We've got a bunch of fantastic guests as well, including Wells Fargo's chief economist, Jay Bryson. And also, we're going to be speaking to the Robinhood CEO on the Pulse. Stay with us. This is Bloomberg.